Hey guys, welcome to The Market is Open. Check us out on themarketisopen.com. And please subscribe to our YouTube channel. We have tons of Tesla videos, so subscribe and hit the bell button for more Tesla videos. Okay, today we're going to talk about some of the concerns that have been going on in the media over the last couple of days. I know a lot of YouTubers were freaking out about some of this stuff, and a lot of investors too. Tesla shares were down about 13% today. So today we're going to talk about the referral program, which recently was announced that it was ending, and it's going to be ending in February. We're going to talk about the 7% cut of the workforce that was announced today, the small Q1 profit coming up, the Q4 profit, which is going to be less than Q3, which is a little bit unexpected, and of course the $920 million in debt payment that's coming up. Okay, so the first thing which was announced a couple days ago was that the referral program for Teslas is going to be ending soon. So this program seemed a little bit unsustainable. It seems like actually the top 10 I guess winners of this program are all YouTubers. So they're just pretty much getting like random people to their YouTube channel who are probably going to buy the car anyway, but they want the free supercharging, so they use the referral code. So these people are like the YouTubers aren't actually referring; they just happen to be sort of a path where people can get referred and get their reward. So Tesla will lose money basically on the supercharging for, I believe it's 6 months, and then they have to give away these roadsters for these, I believe, top 80 people that have had the most referrals. And a roadster is $250,000, and times 80 of them, which is about $20 million in roadsters. And that's just roadsters. Tesla's also giving away fully loaded Model X, Model S, and a bunch of other different prizes for referrals. So the company's definitely losing money, and they recently opened it up to being able to refer Model 3s as well. So because so many more people are buying Model 3s because the price point is lower, there's just so many more referrals, and it's become unsustainable. So I think that's a good thing for Tesla going forward for the company to actually end the program, and that's what they're doing. Okay, so now let's talk about today's news, which was an announcement of a 7% cut in Tesla's workforce. First of all, yeah, funny thing, if you look up workforce cut, you'll see pictures of Tesla everywhere. So the big problem here was that Tesla made a mistake, I believe, in Q2 of last year when they laid off 9% of their workforce, which was around the June timeframe. The biggest mistake that they made, I believe, was saying right here in this quote that Elon wanted to emphasize that we are making this hard decision now so that we never have to do this again. So he essentially, I guess, lied to employees, which you're just going to lose the trust of your employees. So I think that's the biggest problem. The second mistake was that after they laid off their 9% of their workforce, they continued to hire like crazy. If they grew 30% in the year, and the 9% was laid off in the middle of the year, so at least 15, they grew at least 15%, like after their 9% layoffs. So obviously there's tons of excess workers at the company, and salaries are a huge expense, one of the main expenses for a company. So I think trimming 7% is a great idea. Actually, they obviously overhired. Maybe they should even trim more than 7%. Because it sounds like they way overhired, but this whole thing could have been avoided if they didn't hire that many more people after they did their 9% cuts last year. But the 7% cut is actually a good thing. It's not really something to be concerned about. Eventually, I would expect like the entire Tesla factory that's building cars to be mostly or totally automated. So you would think you would need way less employees to do that. But obviously right now it's not completely automated. There's still a lot of employees, especially for sales and service and things like that they even need to boost probably. But they're obviously focusing on cutting the cost down of the car right now. So I think the automation will come later once they sort of get their footing. Okay, so in the letter from today, Elon said that the Q4 GAAP profit is going to be less than Q3. So that was a little bit disappointing. We have a video where we tried to predict the Q4 profit. Mind you, we are predicting the non-GAAP profit, which might still be higher. That wasn't said. Nothing was said about that in the letter. We know that they sold more cars in Q4, so hopefully the revenue is actually higher in the Q4 quarter, which is good. It means that there's still strong demand for the car. But there's probably lower margin because they started selling their mid-range variant. You want to see the company start cutting costs like crazy, as per the 7% workforce cut, in order to start selling that $35,000 car, which they're still a little bit ways away from. So I still think Q3 will be close to Q4 at least. Elon didn't say anything about it being like tiny or anything in terms of profit, but he just said it would be less. But speaking of which, he said Q1 profit will be tiny. They're targeting a tiny profit target, so a lot of things actually need to go right for them to be profitable in Q1. It sounds like they're going to be selling the higher price dual motor cars first in Europe, the same thing they did in the United States. So the first 6 months, there'll be probably a strong demand flow for those dual motor all-wheel drive cars, probably with a lot of options for people that have been waiting for the car for a long time. So that'll be some nice margin for Tesla. And that's sort of required to keep them going for the next 6 months until July, which is basically their deadline when the tax credits get phased out sort of again in the United States, and the price gets cut in half. Sorry, and the credits get cut in half. So they need to cut costs dramatically. I think it's going to be the most challenging 6 months. Investors are going to be looking pretty closely at the cost of the car. They really need to boost production and cut costs like crazy. In order to get 15% margin on a $35,000 car, the cost should be a little bit below $30,000. I don't think demand for the company is an issue. They still haven't announced leasing, which is a huge component of car company sales. And of course, they're still not selling their cheaper car, which will have gigantic demand because $35,000 is around the average price of any car in the United States. So I think the average price is around $32,000. So that's extremely close for this premium car. If as soon as they get it there, I don't think they'll have a problem with demand. I just think they need to get the margin to be positive in order for it to work. So in terms of Q1, a lot of things do need to go right, as Elon outlined in the letter. People weren't happy about this. I think this was the real reason the stock was down 13% today. But they do have a few tailwinds, including these higher priced cars, but they do have that deadline that they need to hit in terms of cutting the cost down of the Model 3. So here's the stock price down 12.97%. Obviously, investors were not happy today about the workforce cuts and the tiny Q1 profit, and also basically the Q4 miss, because people were expecting Q4 to be better than Q3 given that the number of cars sold was higher. So that was a bit disappointing. A couple disappointing things today. I think the workforce cut was the least disappointing thing. Actually, I think that was quite positive. But the outlook for Q1, maybe not negative, but it's certainly something that the company's going to have to work extremely hard to get through the next 6 months. Okay, and one final concern was this $920 million in upcoming debt payment. So basically there's these convertible bonds. The strike price is $359.87. So if Tesla stock price is above that price, then basically the shares get diluted at that price. Like all these bondholders get converted into shares at that price, which dilutes the stock. Elon specifically said that he didn't want to dilute the shares any further. So I'm not sure, Elon did write this letter which knocked the stock price down. So maybe he's purposely knocking the stock price down. I don't think it's on purpose, but he doesn't seem to want to be paying this in stock. The company can afford to pay it in cash. They do have more than enough cash on the balance sheet, though it'll cut their cash position by like around a third. I think they have around $2.5 to $3 billion. And cash did go up, I think, $700 million last quarter. So I don't think paying this off is a huge problem. It's not as big of a problem as people are making it out to be. And I do think Elon he signaled that he wants to pay it in cash, though he hasn't said anything about that. And we'll see if that's the right choice. Maybe the company will be strapped for cash afterwards, but if they remain profitable over the next couple of quarters, then their cash position should hopefully be positive, and then they won't have a problem. They won't be strapped for cash. Also, if there's ever a problem like in the future, I still think that he can always issue more shares. Maybe not at any time. I mean, you want the stock price to be as high as possible when you're issuing new shares. But I mean, Tesla is still a 50-something billion dollar company, and I mean, it can issue shares at that price. It can probably issue $2 billion with a very minimal dilution. So I don't think this is a huge concern for the company. I think the biggest concern that we talked about today was mainly seeing over the next 6 months if the company can really get their costs for the cheapest Model 3 down below $30,000. Anyways, thank you so much for watching. Please smash the like button and subscribe to our YouTube channel. Also check us out on themarketisopen.com. Thanks.